There is a moment that repeats in financial history, a moment when the mathematics stop being theoretical and become violent. When the leverage that created paper fortunes transforms into a liquidation engine that destroys real wealth. It is not a glitch. It is not an accident. It is a mechanism. It happened in 2013, when Bitcoin lost 87% of its value in less than a year, wiping out the first generation of true believers. It happened in 2017, when the ICO bubble vaporized $800 billion of market value, leaving millions holding worthless digital tokens. It happened in 2021, when the collapse of Terra Luna and the fraud of FTX erased $2 trillion from the global economy in a matter of weeks. And every single time, the people living through it believed they were different. They believed they had evolved past the old rules. They believed that new technology made market crashes obsolete. They believed that this time was different. They were wrong. Because what destroys manias isn't external. It isn't government regulation. It isn't bad news. It is mathematical. A 5-stage sequence that plays out with mechanical precision once certain conditions align. And right now, in late 2025, we are in stage 4 of that sequence. The same stage that in 2013 gave way to catastrophe within 8 months. The same stage that in 2017 signaled the top of the mania. The same stage that in 2021 preceded the collapse by mere weeks. This isn't prophecy. This is pattern recognition. And once you see it, you can't unsee it. Let me take you back to early 2013. The world was a different place. The financial crisis of 2008 was still a fresh wound in the global psyche. Trust in banks was at an all-time low. Occupy Wall Street had just faded from the headlines, but the anger remained. And in the darkest corners of the internet, a small group of libertarians and cryptographers were building an alternative: Bitcoin. In January 2013, one Bitcoin trades for $13. It is a niche experiment. Most people have never heard of it. Those who have call it nerd money, or worse, drug money, used only on the Silk Road to buy contraband. There is no Coinbase app on your phone. There are no ETFs. There is no Wall Street involvement. There is only Mt. Gox, a website based in Tokyo, run by a Frenchman named Marc Karpelès. It was originally built to trade Magic the Gathering cards. Now, it handles 70% of all Bitcoin trading volume in the world. Think about that risk. The entire global market for this new asset relies on a repurposed card trading site, run by a man who is reportedly more interested in coding his own coffee machine than managing cybersecurity. But nobody cares about the infrastructure yet, because in March 2013, something happens that lights the fuse. A banking crisis in Cyprus. The European Union forces depositors in Cyprus banks to take a haircut. They literally seize money directly from people's savings accounts to bail out the failing banks. It sends a shockwave through the world. Suddenly, the idea of money without banks isn't just a libertarian fantasy. It is a survival strategy. The narrative shifts overnight. People start looking for a plan B. They look for money that cannot be seized, money that cannot be censored. And they find Bitcoin. This is stage 1, the revolutionary narrative. It is the seduction phase. The promise is intoxicating. Banks charge fees. Bitcoin is free. Wire transfers take days. Bitcoin takes minutes. Dollars can be printed into infinity. Bitcoin is mathematically scarce. And you, the early adopter, you are going to get rich by understanding this before the rest of the world. But here is what nobody understood at the time. When an asset rises because of a story rather than utility, when the narrative becomes more valuable than the product, you are not witnessing adoption. You are witnessing the first stage of a speculative mania. And mania always leads to leverage. This brings us to stage 2, the leverage mania. Between January and April 2013, the price doesn't just rise, it explodes. It goes from $13 to $70, then to $100. Then to $266, a 20x return in 3 months. This kind of growth isn't natural. It acts like a virus. It infects the psychology of everyone who touches it. Imagine buying something for $100 and watching it turn into $2,000 in a few weeks without doing any work. It breaks your perception of value. It makes a regular job feel like a scam. Why work for $20 an hour when you can make $2,000 an hour staring at a chart? And this is where the debt enters the system. People begin borrowing money to buy. They use credit cards. They take out personal loans. They raid their savings accounts. Let me give you a specific example from March 2013 that became infamous on Reddit. A college student, a junior with no income, receives his student loan refund for the semester, $16,000. He is supposed to use this for tuition, books, and housing, but he sees Bitcoin trading at $180. He does the math. He figures he can double his money in 30 days. He tells himself it is a guaranteed investment. He tells himself he is investing in the future of money. So he buys 89 Bitcoins. Within weeks, the price hits $266. His $16,000 has turned into nearly $24,000. He is up 48% in a matter of weeks. He posts screenshots online. The thread explodes. People call him a genius. They call him a visionary. Other students ask him how to do it. He feels invincible. This is how leverage works psychologically. It turns patience into obsession. It turns risk into a game. But notice what he didn't do. He didn't sell. He didn't pay his tuition. He held. Because if it went to $266, surely it would go to $500. Surely it would go to $1,000. Greed doesn't have a target price. Greed only wants more. By April 2013, the mania has gone mainstream. Mt. Gox is adding 20,000 accounts every single day. The servers are crashing constantly. You can't even log in half the time, but nobody cares because the price is still going up. On the Bitcoin Talk forums, people are asking if they should mortgage their houses. They are sharing stories of convincing their grandparents to buy. Taxi drivers are asking passengers how to set up wallets. And that is always the signal. It is the same signal Joseph Kennedy saw in 1929. When your taxi driver is speculating, you are not early. You are late. You are the exit liquidity. But in March 2013, nobody knows this yet. They are too busy counting paper profits. This leads us to stage 3, the warning signs. While retail investors are celebrating, the infrastructure is screaming. Mt. Gox is beginning to fail. In late March, users start reporting lag. Trades are taking minutes, sometimes hours, to clear. Withdrawals are getting delayed. Customer support is non-responsive. These are not small glitches. These are structural failures. But the community ignores them. They rationalize it. They say, it's just growing pains. They say, demand is just too high. They see the failure of the exchange as proof of Bitcoin's success. It is a cognitive dissonance that only exists in bubbles. And underneath the surface, the smart money is moving. Not the hedge funds. They aren't here yet. The smart money of 2013 are the early miners. The cypherpunks who mined thousands of coins on their laptops when Bitcoin was worth pennies. The operators of the Silk Road who need dollars to pay their suppliers. They are quietly selling. They aren't posting about it. They aren't arguing on forums. They are just hitting the bid. They are transferring their risk to the college students and the credit card speculators. In every bubble, there is a silent transfer. Wealth moves from the impatient to the patient, from the believers to the realists. But the crowd is too intoxicated to see it. They have invented a new language to justify their blindness. Skepticism is called FUD. Fear, uncertainty, and doubt. Selling is called having weak hands. Buying the top is called conviction. Holding through volatility is called hodling. It becomes a cult. If you question the price, you are an enemy of the revolution. If you suggest taking profits, you simply don't understand the technology. This psychological shift is crucial. It is the signature of stage 3, when the price becomes its own justification. It's going up, therefore it must be worth it. And then, inevitably, comes stage 4, the crack. It happens on April 10, 2013. The day starts with euphoria. Bitcoin is trading near its all-time high of $266. But the volume is too high for Mt. Gox to handle. At 10 a.m., the lag begins to spike. Traders place buy orders, but they don't execute. They place sell orders, but nothing happens. The price on the screen freezes. Panic begins to ripple through the chat rooms. Is it a hack? Did the government shut it down? Did Mark Karpelès run away with the money? Nobody knows. This is the fog of war. And in the absence of information, fear fills the void. At 12 p.m., Mt. Gox halts trading completely. The engine stops. Millions of dollars are trapped in limbo. For an hour, there is silence. And then, trading resumes. And the floodgates open. Everyone wants out at the same time. But there are no buyers. Who would buy in this chaos? The liquidity evaporates. The price doesn't slide. It teleports. $260, $220, $200, $150. And this is where the leverage kills you. Remember that student? The one who borrowed $16,000? He is watching the chart in his dorm room. He is refreshing the page every second. At $200, he is still in profit, but he is paralyzed. He thinks it will bounce back. At $180, he is back to break even. He tells himself, if it goes back to $200, I'll sell. But it doesn't go back to $200. It goes to $120. Now he is losing money. Real money. Money he doesn't have. Panic takes over his entire nervous system. He imagines telling his parents. He imagines defaulting on the loan. He imagines dropping out of school. So he does the only thing he can do. He capitulates. He sells at the bottom of the wick. He clicks sell at $100. He walks away with less than $9,000. He still owes the bank $16,000. His tuition money is gone. His credit is ruined. And he is not alone. Thousands of positions are liquidated in hours. This triggers a cascade. Forced selling drives the price lower. Lower prices trigger more forced selling. It is a death spiral. The exchange crashes again. When it comes back online, Bitcoin is trading at $60. By April 15th, 5 days later, the crash is complete. Bitcoin has fallen 76% in less than a week. The media immediately writes the obituary. Bloomberg calls it the Bitcoin bubble burst. The Atlantic writes, the end of Bitcoin. Economists go on TV and laugh. They say, we told you so. They say, it was a Ponzi scheme. This brings us to stage 5, the Purge. By November 2013, the price has bottomed out. Most of the speculators are gone. They didn't just lose money. They lost their faith. They are embarrassed. They are silent. The forums that were full of rocket emojis are now graveyards of despair. The suicide hotline is pinned to the top of the Reddit page. People are posting stories of lost marriages, lost homes, lost futures. It is a total washout. The only people left are the true believers. The builders who are still writing code. The miners who are still running nodes. The people who understood that the price is not the protocol. The price stabilizes. The volatility dies down. The world moves on. And looking back, the pattern is crystal clear. Stage 1, the narrative. The story of freedom money. Stage 2, the leverage. The explosion of debt-fueled speculation. Stage 3, the warnings. The infrastructure cracking while insiders sell. Stage 4, the crack. The liquidity crisis and the panic. Stage 5, the purge. The total destruction of wealth and the exit of the tourists. This was the template. It was the first time the pattern played out in full. And if you were watching closely, you learned a lesson about human nature that is more valuable than any economics degree. You learned that markets are not efficient. They are emotional. And they are cyclical. The terrifying part is not that it happened once. It is that 4 years later, with a completely new group of people, with better technology, with more media coverage, it happened again. With bigger numbers, with more leverage, and with even more victims. Because the pattern doesn't care about technology. It only cares about psychology. And psychology never changes. Let's look at 2017. If 2013 was the prototype, 2017 was the template. It was the moment the virus mutated. It became stronger. It became faster. And it found a new story to tell. By 2017, the narrative of digital gold was too simple. It wasn't enough to fuel a global mania on its own. The market needed complexity. It needed a promise so big, so abstract, that nobody could value it. Enter Ethereum and the initial coin offering. The narrative shifted from replacing money to replacing everything. We were told that smart contracts would replace lawyers. We were told that DAOs would replace corporations. And most seductively, we were told that ICOs would replace Wall Street. This was stage 1, the new narrative. The pitch was irresistible. Why let venture capitalists eat all the profit? Why not let the people fund the future? Suddenly, anyone with a laptop and a white paper could raise millions of dollars in minutes. There were no regulations. There were no background checks. There was just a wallet address and a dream. Between 2016 and 2017, over 900 ICOs raised $6 billion. The quality control evaporated instantly. It became a theater of the absurd. There was Dentacoin, a blockchain specifically for dentists, which reached a market cap of $2 billion. There was Ponzicoin, which literally told investors it was a pyramid scheme, and people still bought it. There was the useless Ethereum token, which promised to do absolutely nothing. It raised $300,000. Because in stage 1 of a mania, cynicism dies. Greed blinds you to irony. This brings us to stage 2, the leverage explosion. In 2013, leverage was crude. By 2017, the industry had built a Death Star. It was called BitMEX. Based in the Seychelles, it introduced a weapon of mass destruction to retail traders, the perpetual future. And with it, 100x leverage. Let me explain exactly what 100x leverage means. You deposit $1,000. The exchange lends you $99,000. You now control a $100,000 position. It feels like magic. If Bitcoin goes up just 1%, you double your money instantly. But mathematics is cruel. If Bitcoin drops just 1%, a tiny, normal fluctuation, your position loses $1,000. Your collateral is wiped out. The exchange liquidates you instantly. It is financial suicide disguised as trading. But in 2017, nobody looked at the downside. They only saw the upside. By Thanksgiving 2017, the mania had infected the real world. It was the topic of every dinner table in America. You had grandmothers asking how to buy Ripple. You had teenagers explaining the blockchain to their parents. The Coinbase app rocketed to the #1 spot on the Apple App Store. It was downloaded more than Instagram, more than Facebook. 100,000 new accounts were being opened every single day. The infrastructure was melting down, but the enthusiasm was nuclear, and fueling it all were the influencers. This was the golden age of the crypto guru. Men who were broke 6 months ago were now live streaming from rented Lamborghinis. And the king of them all was John McAfee, the creator of the antivirus software, living in exile, armed with a Twitter account and a total lack of shame. He began tweeting a coin of the day. Every day, he picked a random token. Every day, the price would double in minutes. He was the Pied Piper of the bubble. But his most famous moment came in July 2017. He looked at the camera and made a bet. He said that if Bitcoin did not hit $1 million by 2020, he would eat his own private parts on national television. It sounds insane now. But in 2017, people believed him. They wanted to believe him. Because if he was right, they were all going to be millionaires. This is stage 2, when a prediction of $1 million is treated as conservative analysis. Then came stage 3, the warning signs. They were everywhere, flashing red. In September 2017, China banned ICOs. The market crashed 20% in a day, but then it bounced back. China bans Bitcoin every year, the crowd said. Jamie Dimon, the CEO of JP Morgan, called Bitcoin a fraud. If you're stupid enough to buy it, you'll pay the price, he said. The crowd laughed at him. They said he was a dinosaur. Then there was Tether, a mysterious company printing billions of dollars to back their stablecoin. Critics pointed out they had never been audited. They pointed out that every time Bitcoin dipped, Tether printed money, and the price recovered. It looked like market manipulation, but the crowd screamed, FUD. They didn't want the truth. They wanted the number to go up. And underneath the noise, the insiders were leaving. The ICO founders were cashing out their Ethereum. The miners were selling their Bitcoin. The smart money was handing the bag to the retail public. And then, stage 4, the crack. It happened on December 17, 2017, the day Bitcoin futures launched on the CME Group. For the first time, Wall Street could bet against Bitcoin. The price hit $19,783. And that was it. The buying pressure evaporated. The selling began. It wasn't a crash at first. It was a slow, agonizing slide. $17,000, $15,000, $13,000. At every level, people bought the dip. It's just a healthy correction, they said. Institutional money is coming, they said. They were bargaining, but the leverage had turned against them. As the price fell, those 100x long positions began to explode. Liquidations triggered sell orders. Sell orders lowered the price. Lower prices triggered more liquidations. The death spiral had begun. And as the tide went out, the ICOs began to collapse. Projects that had raised $50 million suddenly ran out of funds. Founders deleted their Twitter accounts. Telegram channels went silent. It was a mass extinction event. And the face of the collapse was BitConnect, a lending platform that promised 1% daily interest. It had a market cap of nearly $3 billion. On January 16, 2018, the regulators closed in. The website shut down. The token price fell 96% in a single day. People lost their life savings overnight. The internet was flooded with videos of victims screaming, "My wife doesn't believe me. I lost the house money." It was the moment the dream died. This brings us to stage 5. The Purge. The slide continued for a year. There was no V-shaped recovery. There was only pain. By December 2018, Bitcoin hit $3,100, an 84% drawdown from the peak. Ethereum fell to $80, a 94% drawdown. 95% of the ICOs went to zero. They didn't just fall, they ceased to exist. The mining rigs were turned off and sold for scrap metal. The crypto gurus deleted their videos and disappeared. Bloomberg wrote the article, "Bitcoin is dead." The pattern was complete. Stage 1. The narrative of democratization. Stage 2. The leverage of BitMEX. Stage 3. The warnings of regulation. Stage 4. The crack of liquidity. Stage 5. The purge of the tourist. The mechanics were identical to 2013. Only the zeros had changed. And as the dust settled in 2018, the survivors looked at the wreckage. They thought, surely we won't let this happen again. They were wrong. Because 4 years later, we did it all over again. If 2017 was a retail mania driven by amateurs, 2021 was an institutional delusion driven by professionals. This time, the numbers weren't in the billions. They were in the trillions. And the participants weren't just kids in basements. They were the masters of the universe. Stage 1. The institutional narrative. In 2020, central banks panicked. They printed trillions of dollars to fight the COVID pandemic. The money supply exploded, and a new narrative was born to capture it. Bitcoin wasn't just digital cash anymore. Bitcoin was digital gold. It was the only hedge against the inevitable inflation. And this time, the buyers were corporations. MicroStrategy converted their entire treasury into Bitcoin. Tesla bought $1.5 billion worth. Wall Street hedge fund managers went on television and declared Bitcoin the fastest horse in the race. Politicians put laser eyes on their Twitter profiles to signal allegiance. The validation was intoxicating. They told us, the institutions are here. They told us, there is a floor price now. They told us, it is a super cycle. They believed that because they were involved, the market could no longer crash. They were wrong. Stage 2. The everything bubble. By late 2021, the total crypto market cap hit $3 trillion. The speculation reached levels of insanity that made 2017 look rational. We witnessed the birth of the NFT mania. Computer-generated pictures of bored apes were selling for $300,000. Digital rocks, literally clip art of rocks, sold for millions. Justin Bieber bought a JPEG for $1.3 million. We were told it was culture. We were told it was community. It was actually just a bubble of excess liquidity finding the silliest possible outlet. And then there was DeFi. Decentralized finance. This was the engine of the bubble. Platforms like Anchor Protocol promised 20% guaranteed interest on your savings. Celsius Network promised 18% yields and told you that banks are not your friends. But nobody asked the most important question in finance. Where's the yield coming from? It wasn't coming from business revenue. It was coming from printing new tokens to pay old investors. It was Ponzi economics, wrapped in complex code, sold as innovation, and the leverage was hidden in the shadows. Hedge funds like Three Arrows Capital were borrowing billions of dollars to bet on tokens that had no fundamental value. Retail traders were using 100x leverage on offshore exchanges. It was a tower of cards built on top of a tower of debt, held together by a promise that number go up. Stage 3, the warnings. They were loud, and they were ignored. China banned Bitcoin mining in May 2021. Half the network went offline overnight. The price crashed, but the believers just shrugged. Elon Musk turned on Bitcoin, calling it environmentally unfriendly. The SEC chair explicitly warned that the industry was rife with fraud, scams, and abuse. Insiders at Coinbase dumped nearly $5 billion of stock immediately after their IPO. The smart money was exiting, but the market ignored it all. Bitcoin hit $69,000 in November 2021. Euphoria blinded everyone to the mathematics. And then, stage 4, the crack. It started on May 9, 2022, with a project called Terra Luna. It was a $40 billion ecosystem. It had a stablecoin, UST, that was supposed to be pegged to the dollar. But it wasn't backed by dollars. It was backed by an algorithm. It was backed by the belief that the Luna token would always have value. On May 9th, the belief broke. The peg slipped. 99 cents, 90 cents, 60 cents. The algorithm tried to save the peg by printing more Luna tokens. It printed millions, then billions, then trillions. It triggered hyperinflation in real time. In 48 hours, $60 billion of wealth evaporated. Luna went from $80 to fractions of a penny. It was a mathematical impossibility becoming reality. People lost their life savings in 2 days. But Terra Luna was just the trigger. It was the first domino in the leverage chain. Stage 5, the collapse. The contagion spread instantly. Three Arrows Capital, the biggest hedge fund in the space, had bet everything on Luna. They defaulted on billions in loans. The lenders, Celsius, Voyager, BlockFi, started falling like dominoes. Celsius froze withdrawals. Millions of users logged in to find their accounts locked. Unbanking yourself turned into donating your life savings to a bankruptcy court. And then, the final blow. November 2022. FTX, the second largest exchange in the world, run by Sam Bankman-Fried, the golden boy of crypto. He was on the cover of Forbes. He was donating millions to politicians. He was the face of regulation. It turned out he was running a massive fraud. He was using customer funds to gamble in his hedge fund, Alameda Research. When a rival exchange threatened to dump their tokens, a bank run started. Sam tweeted, "FTX is fine. Assets are fine." They were not fine. The money wasn't there. $8 billion of customer money was missing. The exchange filed for bankruptcy. Sam was arrested in the Bahamas. Bitcoin crashed to $15,000, a 77% drop from the peak. Ethereum lost 82%. The total market lost $2 trillion. 3 cycles. 3 identical patterns. The scoreboard reads, 2013, 87% crash. 2018, 84% crash. 2022, 77% crash. Stage 1, the revolutionary narrative. Stage 2, the leverage mania. Stage 3, the warnings ignored. Stage 4, the liquidity crisis. Stage 5, the purge. The pattern is undeniable. It is not an opinion. It is not a prediction. It is a historical fact. It has happened 3 times in a row. And the only question left to ask is simple. Are we about to see it again? Now, I need you to pay close attention, because we are not studying history anymore. We are studying the present. We are studying your money. Every single element of the 5-stage pattern is present in the market right now. Let's go through them systematically. Stage 1, the narrative of 2025. The story has evolved again. It is no longer just about institutions. It is about nation-states. The narrative is that Bitcoin has become a geopolitical weapon. With the approval of the ETFs in 2024, BlackRock and Fidelity legitimized the asset. And now, with the talk of a U.S. strategic Bitcoin reserve, the promise is ultimate safety. They tell us that governments are buying. They tell us that the sovereign wealth funds are coming. They tell us that Michael Saylor has cracked the code of infinite money. MicroStrategy is no longer a software company. It is a leveraged Bitcoin hedge fund that sells bonds to buy coins. Saylor tells us Bitcoin is the apex property of the human race. He tells us to sell our houses and buy Bitcoin. It is the most seductive narrative yet. Because if governments are buying, how can it lose? This brings us to stage 2, the leverage mania. Look at the numbers. Bitcoin has rallied from $15,000 to over $100,000 in 2 years, a 600% move. And with the price, the greed has returned. But it's not just Bitcoin. Look at the meme coins. We have tokens named after dogs, cats, and internet jokes reaching billion-dollar valuations in days. We have AI tokens that are nothing but a website and a promise, trading at higher valuations than real tech companies. The leverage in the system has exploded. Offshore exchanges are offering 125x leverage again. Funding rates, the cost to borrow money to buy crypto, are hitting annualized levels of 50 to 100%. People are paying 50% interest just to hold a long position. That is not investing. That is desperation. We have checked the box for stage 1. We have checked the box for stage 2. Now, look at stage 3. The warning signs. They are flashing brighter than they did in 2021. First, look at the systemic risk. Tether, the stablecoin that underpins the entire market. There are now 142 billion tethers in circulation. That is $142 billion that supposedly sits in a bank account somewhere. But despite years of promises, there is still no full, independent audit. If Tether breaks, if they lose even 5% of their peg, the entire crypto market loses its pricing mechanism. It would be a liquidity shock, larger than Lehman Brothers. Second, look at MicroStrategy. Michael Saylor has built a structure that looks terrifyingly similar to the investment trusts of 1929. He has borrowed billions of dollars to buy an asset that yields nothing. If the price of Bitcoin drops by 50%, the value of his company's stock could drop by 90%. His bondholders could force a liquidation. He is the largest potential forced seller in history. If he is forced to sell, he won't be selling millions. He will be dumping tens of billions of dollars onto a market that cannot absorb it. Third, look at the divergence. The narrative is that Bitcoin is an inflation hedge, but when inflation peaked in 2022, Bitcoin crashed. The narrative is that it is uncorrelated to stocks, but today it moves in perfect lockstep with the Nasdaq. The narrative is cracking, and the smart money knows it. Venture capitalists are slowing their deployment. Insiders are selling their tokens. Whales are moving coins onto exchanges. They are positioning for the exit. Which brings us to right now. Stage 4, the crack. We are standing on the edge of the cliff. We haven't fallen yet. The price is still high. The confidence is still total. But the conditions for the cascade are set. We have record leverage. We have a concentrated holder base, where the top 1% own 90% of the supply. We have regulatory uncertainty looming. All we need is a trigger. It could be anything. It could be a regulatory crackdown. It could be a recession in the traditional stock market. It could be a depegging event. Or it could be nothing at all. Just a random sell order that triggers a chain reaction. And when it starts, the mathematics will take over. A 10% drop triggers the liquidations of the 100x leverage traders. Their forced selling pushes the price down another 10%. That triggers the 50x leverage traders. The price drops further. Panic sets in. The ETFs, which promise stability, will turn into selling machines as retail investors hit the sell button. MicroStrategy stock will plummet, raising fears of margin calls. It is a death spiral, waiting for a spark. And that leads to the inevitable stage 5, the prediction. Based on 3 previous cycles, we know what happens next. It won't be a soft landing. It will be a purge. If history repeats, we are looking at a 70 to 90% drawdown from the peak. If Bitcoin is at $100,000, that means a crash to $30,000 or even $20,000. Altcoins, Solana, Cardano, the meme coins, they will lose 95 to 99% of their value. Most will never recover. The exchanges that played loose with customer funds will fail. The stable coins that aren't fully backed will break. The media will declare crypto dead for the 400th time. And millions of people who bought the top because they believed the supercycle narrative will lose everything. This is not fear-mongering. This is history. The pattern has played out 3 times with 100% accuracy. Why would you bet your life savings that the 4th time is different? Now I need you to understand something. The crash, when it comes, won't be your fault. You didn't create the leverage. You didn't print the Tether. You didn't build the Ponzi schemes. The system is designed to create manias. It is designed to transfer wealth from the late majority to the early minority. Stage 5 is a mathematical inevitability, but surviving it? That is your responsibility. The pattern is clear. The stages are marked. We know what is coming because we have seen it before. In 2013, in 2017, in 2021, each time there were people who saw the signs. They sold into the strength. They preserved their capital. And when the dust settled, they were the ones with the cash to buy the bottom and build generational wealth. And there were the others. The ones who held on. The ones who believed the narrative instead of the numbers. The ones who became the cautionary tales. We are in stage 4. The crack is forming. The choice of which group you belong to is yours. The pattern repeats. The question is, will you?